Well, welcome everyone, and welcome to the 2024 Tippie Women Summit. Today's event is titled Smart Money for Smart Women, Financial Strategies for Life Stages. My name is Barbara Thomas, and it's my pleasure to coordinate today's event. Now, before we dive into the topic, I do want to remind you that there are several other Tippie Women Summit events. The two earlier webinars are available on our website, and we have one more event in person. This one will take place on Tuesday, March 26th at the Courtyard Marriott Hotel at 901 West Melrose Avenue here in Iowa City. This event will be an interactive workshop with the title, Color Yourself Happy, Working with Different Personalities and Effectively Managing Workplace Triggers. So if you're able to join us, please do so. Information on all of these events, as well as the recordings of these webinars, are available on the Tippie Women Summit website. I'll put a link in the chat today. Now, a reminder that you can ask questions of our panelists through the Q&A button, which should be at the bottom of your screen. And you can also share comments in the chat to the panelists and to everyone. Now, I do want to remind you, though, that this is a big topic and we're trying to cover a lot in a short period of time. And because of that, we probably won't be able to dive into questions that are very specific about your situation. So we want to remind you that really the best person to answer that question is your own financial advisor. So we do recommend that you hire somebody who is a fiduciary and who can advise you on those specific questions that you might have. Now, before we begin, we do have to give you a bit of the legalese, okay? This Tippie Women Summit webinar is designed to provide an overview of matters that you may wish to consider at different stages of your life. The webinar information does not and is not intended to constitute legal or financial advice. Instead, all webinar information, content, and materials are for general information purposes only. Please contact your personal financial advisor or attorney to obtain advice with respect to your specific circumstances. So now on to today's program. We're featuring 3 Iowa finance alumni who are each finding success as financial managers. Allie Branca received her BBA in 2006, while Mary McBride received hers in 2007 in both finance and economics. And our third panelist, Claudia Marban, received her BBA in finance in 1999, along with a BA in Spanish and the International Business Certificate. Our discussion today will be led by Amrita Nain. Amrita is an associate professor of finance and holds the Dore-Tippie Research Fellowship. In addition, she serves as the advisor to the student organization Invest Her, which is providing women in Tippie's finance program with connections, insights, and support as they explore careers in finance. And with that, I will turn it over to Amrita.
Thank you, Barb, and welcome everybody to Tippie's Women's Summit. Today we'll be hearing from 3 financial managers, and if time permits, we will try to answer questions from the audience after their presentation is over. And I want to reiterate that, as Barb mentioned, the panelists will be providing general information to help you through the decisions you make in life. They're not able to answer questions that are specific to your financial situations, for which we recommend that you hire a financial advisor. So with that said, we will begin with our first panelist, who will talk about early career financial planning. So Mary McBride began her career as an investment banker with Piper Jaffray in Chicago and Boston, and then later worked as a management consultant for the Winterberry Group in New York City. And after stepping away from the corporate world to focus on her growing family, she joined Criterium Financial Advisors, where she draws on her financial skill set and passion for markets to help her clients. So I will hand this over to you, Mary.
Thanks so much, Amrita. Hi, everyone. Thanks for having me, and thanks so much to Barb for organizing this great event. I wanted to kick off today by answering a quick question that we got from a webinar participant that really stuck in my head, which was, is there a difference women need to be aware of when creating financial strategies? Like, why are we doing this? Shouldn't good financial strategy be universal? And really, the answer boils down to, on average, women make less money and live longer than men. So we're under pressure to be a bit more aggressive with our saving and more strategic with our life planning in order to maximize our quality of life now and in retirement. So with that framework in mind, here are my 3 most important financial to-dos for women in their 20s. The first is to take advantage of employee benefits, especially a 401k match. The second is to learn discipline around budgeting. And the third is to plan your future with intention. So you use this time of your life productively to move you toward your goals and be better prepared to handle curveballs that might come your way. Okay, next slide. So the number 1 most important benefit I don't want you to sleep on is any kind of a 401k match. An employer match is free money. It's an automatic raise. It's a 100% return on investment instantly. And all you have to do is elect to participate. This is a beautiful thing, especially at the beginning of your career, because you have a long time horizon to let your money grow. Check in with your HR department to make sure you're taking advantage of other financial incentives. Ask about student loan repayment. There's been a pickup in companies offering this thanks to a tax incentive in the CARES Act. It can also be easy to ignore smaller perks like pre-tax commuter benefits, healthcare savings accounts, or gym reimbursements. But if they're offered and they make sense for you, the tax savings can really add up, and nobody's going to hunt you down to give this money. Certain policies may be more important to you once you have beneficiaries, but it's good to know what your company offers so you have an idea of whether those policies are going to meet your needs if and when the time comes. I also left a link here for the previous Tippie webinar series that goes into more detail on this topic if you want to learn more. Okay. And then on the next slide, I would be a financial advisor if I didn't include a chart to show you how to become a millionaire through the power of compounding interest. In this situation, we have a very basic scenario where an employee makes $60,000 a year and participates in a 5% match. They start at their job at age 22 and retire when they're 65. Very nice return. Ultimately, 2 factors matter in investment return: your rate of return and your number of compounding periods. You really don't have a lot of control over what the market returns. It's hard to consistently outperform over time, but you do have control over how long you're invested. So starting early is one of the best ways you can build wealth. Okay, so the match is really enticing because it's extra money, of course. But if your job doesn't offer one, you can still achieve this gorgeous compounding either through the company plan or if they don't offer one in a traditional or a Roth IRA. Claudia is going to talk more about the different types of tax advantaged accounts in the next section, but for now, let's focus on budgeting. All right, so you have a job, you're contributing to your retirement fund, you're doing amazing. The next tip I'm going to cover is get a grip on your budget. Here's what you do. Understand your cash flow situation. Look at where your money's going over time to understand your habits and fix overspending. Avoid consumer debt. You must not carry a balance on your credit card. It is so expensive and it ruins your ability to save. Put practices in place to make responsible budgeting your default choice. If your approach to budgeting, saving, and investing requires you to take a lot of individual actions each period, you're introducing a lot of points of failure. Set it on auto and make yourself take action to go off budget. Okay, next slide. There are so many ways to budget. The 50-30-20 method is just one popular framework. And that gray section at the top of the bar chart, that represents the part of your paycheck that's going to be missing when you get it. Sorry. That's your bill to Uncle Sam, your health insurance. The darker gray portion is your retirement election, which is like still your money, but you don't get to spend it. The colorful portion at the bottom, that's your take-home pay. This is the number you apply to the 50-30-20 allocation when you're building your budget. I included a couple of rules of thumb here for major categories, but this varies so much depending on your personal situation, your geography, your lifestyle. The blue portion, that's your needs. This is comprised of a lot of fixed expenses, so be particularly careful to set them well within your means. You tend to be locked into them for a long period of time, and if you end up with rent or a car payment you can't afford, that's a real budget killer. I also love the way this budgeting formula Gives you an allocation for discretionary spending. Sure, we're trying to set ourselves up for a secure future, but we're also just living our lives. We want to be happy. We want to have fun. So make sure you have room in your budget for joy. And if you feel like you don't have that, find a way to level up your income or drastically decrease your cost of living. With respect to the 20% of the budget that you're aiming to save, prioritizing these dollars is a little tricky and it will be different for everyone. Start with an emergency fund, pay down any high interest debt, then open goal-specific investment accounts. You can save for things like a payment, a vacation, another major expense, children's educations. You could also include additional retirement savings from this part of your budget, but you want to keep in mind that once you put it into a tax advantage account, it's really locked up until you're like 50 and a half. So if you need that money in the near term, it may not be a choice for you. If you do have a background or an interest in finance, you might feel really comfortable building and executing on a savings and investment strategy tailored to your life and risk tolerance. If that's not you and you feel kind of overwhelmed thinking about, gosh, how do I prioritize paying off my car versus starting an IRA, and what's an allocation, and I don't even know what an ETF is. In that case, working with a trusted financial advisor to get a strategy in place might be good for you. You may feel hesitant to spend money for a service like when your literal goal is to save money, but having a good plan in place and knowing how to execute is going to give you confidence to get going, and it'll help you avoid really costly mistakes. I also just want to quickly nod to the virtues of automation and achieving budgeting success. Use auto-pay for your bills and set up automatic transfers from your checking into your savings and investment accounts. That way, what naturally remains in your checking account is your discretionary budget with like a little buffer so you don't overdraw. But this is smart for a lot of reasons. One, you don't see a big number in your checking account, so you don't feel like you have money to burn. And then two, the rate of return on your checking accounts is peanuts. You don't want to hold money where you're not earning interest. Okay, next slide. So I'm not even really going to talk about this slide. It's kind of a bonus for you when you download the slides after the topic. If you're really worried about your credit score, if you're planning to get a loan, then read through this and try to maximize your credit factors. If you're not applying for a loan, don't worry about this. Just pay your credit card off in full on time, and that'll do the heavy lifting of building solid credit. Okay, the last topic I want to cover today is plan for the road ahead. When I was interviewing for jobs in my 20s, where do you see yourself in 5 years was a popular interview question. I hated it. I didn't have a plan. My plan was to be opportunistic. Who knew where I'd be in 5 years? Of course, looking back now, I realize I probably could have sketched a fairly reasonable outline of my life thus far. I got married, we had kids, we bought a house, we bought a car. So my recommendation to young people is think about the life you want for yourself. Even if it's a little bit scary, look directly at it. The basic exercise of setting your intentions is going to help you set and save your financials. It's so much easier to skip brunch to save money when you know that you're putting away for a trip you're excited to take. And it's always just feel like you're scrimping and saving to be responsible. This type of financial planning exercise always reminds me of that episode of Friends when they all turned 30 and Rachel's like, oh, I still have plenty of time to date casually and then have a baby when I'm 35. But then she starts sequencing the steps to achieve that goal and she realizes that she has less runway than she thinks. My point is, we all have less runway than we think. Let's get started today. Okay, next slide. So I alluded to this at the beginning of the presentation, but here's a little bit more detail about the women's issues that we're up against. You don't know how much restraint it took me to not include an America Ferrera and Barbie style rant about how the cards are stacked against us, but girls, we don't have time to be angry, we gotta stay focused. The important thing to acknowledge and plan around these financial pitfalls when you're young and you're making choices about like what company to work for, when to pursue your graduate degree, how much to spend on your wedding. Think about your timeline and think about your personal goals to work, motherhood, retirement, etc. And just make the best spending, saving, and career choices you can with the information you have available. It's really all we can do. It's easy to sort of hope we won't be personally affected by this or assume that societal progress has negated these factors. but we really need to walk through life with our eyes wide open. Unsurprising to any of the mamas out there, no one factor putting women at a disadvantage in motherhood. But I want to shout out to my single sisters who are tired of moms making it all about us. You guys have an advantage when it comes to lifetime income, but you're also impacted by other factors like the paying tax and the single tax. The single tax isn't even gender specific, but it's still part of the math that needs to be factored in for single women. So everyone stay focused. My last point on this slide, just keep in the game with respect to marital finances. You might want to outsource the work, but if you have the best chance of getting a fair division of assets, if you know what you have and where the money is. This is another great time to work with a financial advisor to make sure you're getting the best outcome. And then one more plug here for the previous Tippie webinar series. There was really great information about love and money. So if this topic applies to you, go check that out. Okay, and then I want to circle back to my earlier 401k contribution slide. Remember when we worked and saved for 43 years? Well, this chart contemplates a situation where a person works for only 10 years, maximizing their 5% match, and then never contributes to this account again. Maybe they decide to stay home with kids, maybe they leave a corporate job and go freelance. You can imagine a lot of scenarios, but just look how well saving early served them. If the person would have saved $400 a month instead of just $250, they would have broken $1 million out of these assumptions. So this is just some inspiration for you all to like make hay while the sun shines. What I want to caution you against is when you leave a job, do not cash in your 401k. Not only is it going to cost you an immediate 10% early withdrawal penalty if you're younger than 59 and a half, it could also cost you hundreds of thousands of dollars in future earnings. You've already done the hard work of saving and investing. Don't trade your future for a kitchen renovation or a new minivan. If you can't afford it now, save for it separately. Okay, so that's my time. I want to thank you so much for participating. If anyone has questions on this content, here's my contact information. Feel free to reach out to me directly. And with that, I'll toss it back to Amrita.
All right, thank you, Mary, for these excellent discussions. For the audience, we apologize for the audio breakup, but we will make sure that you have the slides available for you after the webinar is over. We can see a few questions popping up in the Q&A, which we will try to address at the end of the webinar. I want to hop right to introducing our second speaker, Claudia Marban, who will talk about midlife financial planning. Claudia is a private wealth advisor and president of Claudia Marban and Associates, a private wealth advisory practice of Ameriprise Financial Services, located in Frankfort, Illinois. With 24 years of experience as a financial advisor, Claudia has presented numerous educational seminars and has coached and mentored countless advisors within Ameriprise. She has been a Chicago 5-star wealth manager since 2012. Claudia, I'm going to hand this over to you now.
Thank you, Amrita. Well, thank you again, Amrita, and thank you to Mary for all of your insights, especially for all those starting earlier in their career. A lot of great advice on managing debt, managing your cash flow, understanding your discretionary income, and of course, leveraging employer benefits. I think all of that's very important as we're starting our careers. And for many of you that are joining us today, I'm sure you live very busy lives, not just your careers, but you're managing your life in general. You're probably balancing life between your kids and maybe even caring for your loved ones. And so it's a busy time and you don't always have time for yourself. But it's important that we all carve out the time to focus on ourselves and what our goals are. And so it might be a great time to look at partnering up with a financial advisor if you haven't done so already, and work on doing financial planning where you can collaborate to look at what your goals are and how can you turn those dreams into reality. So I'm going to use this framework here. This is our confident retirement approach. To me, it's like building a home. So when you're building a home, the most important part is to first have a solid foundation. And that's really covering your essentials. It's making sure that you do know your cash flow, you know what's left over every month so you can allocate to your goals, and having a cash reserve. So typically we'd recommend at least 3 to 6 months of your expenses, but of course you can always have more. So having that solid foundation is important before you can start on the house framing, right? Before you're framing that house, you got to have that solid foundation. And as I think of that next part, it's looking at the framework of your goals. So what are your goals? Have you thought about your short and long-term goals? Have you thought about retirement? And when would you like to know you can walk away? When can you retire? Have you saved enough? Are you putting your money in all the right places? Have you accounted for inflation and market volatility? So these are all the questions we ask ourselves as we're planning that framework of our goals to ensure our lifestyle. Now, before you move into that house, as many of you know, there's a lot of inspections along the way, right? A lot of codes and inspections to make sure that your home is safe for you and your family to live in. Well, we really need to do the same for our financial lives. We need to prepare for the unexpected. And we're going to talk about a little bit about that today as well. Lastly, once your home is complete, you're living the dream, enjoying that home. But then the next step is, okay, now that I've done that, what's the next step? What is my lasting mark on this earth? What do I want to do for my family, my friends, all the organizations I care about? Do I have that in writing? So these are some of the topics that we'll talk about today. Next slide. So as you're thinking about all these goals, and again, they can be short-term, long-term, there's specific places where you can put your money. And we certainly want to focus on the importance of diversification from an asset allocation standpoint. That's important, but also considering tax diversification. So when you're saving for your goals, there's really 3 buckets where you can put your money. Bottom left-hand corner there is our taxable. So that's money that you're putting in after tax, and it is taxable along the way. And when you withdraw it, you're probably still paying taxes. That could be your savings accounts, CDs, mutual funds, stocks, accounts that are non-qualified, non-IRA, non-401k. We need to have assets there, right? Because we need to sustain our lifestyle or fund our shorter term goals that are going to be something we're accomplishing before age 59 and a half. So it's important to have some money in that taxable portion. On the right-hand side is our tax deferred. So tax deferred is typically your 401k or 403b, 457, IRA. These are savings where you're putting money in before tax or pre-tax. They're growing tax deferred, which is great. But then when you pull the money out, that's when you're going to pay the taxes. And also non-qualified annuities would fit in this category as well, because that's money going in after tax. That's also tax deferred. But again, when you withdraw it, you're paying taxes. The third bucket, which is on that top tier there, is our tax-free. So that's going to be assets that you're putting in after tax. They're growing tax deferred, but when you withdraw them, they're completely tax-free. So some of the options and solutions there would be Roth IRAs, 529 plans, health savings accounts, and cash value life insurance. So as an advisor, I'd say when we are starting to work with a new client, a lot of times we'll see the majority of the assets in the tax deferred and the taxable buckets. That's where we see the majority. But in an ideal world, we want to work on getting a balance. So if you had a mix of, and as an example, 30% of your assets taxable, 40% tax deferred, and 30% tax free. And the benefit of that is it's going to help to create flexibility and also tax efficient distributions when you're funding those goals, whether those be short or long-term goals. So we'll talk about that in just a moment. Next slide. So mention a little bit on savings for goals, again, retirement and college. And I know many of you had questions on college savings. So many times we'll get the question, well, when should I start saving for college, right? Well, as early as possible, right? There's never too early time to start saving for college, retirement, or any of your financial goals. And when you're thinking of college, or again, any financial goal, you want to think about what is the goal. So do we want to fund 25% of college? Do we want to fund 100% or somewhere in between? Are we funding private school, public, in-state, out-of-state? There's so many factors to consider. And of course, you don't know yet where your children are going to school, right? So that's where you need to have flexibility. So I've pulled up here a couple examples of different investment strategies for saving for that goal. Again, there's a lot of unknowns. You don't know where your child's going to go to school. So you want to keep a flexible plan, which you're kind of hearing the theme here of what we're talking about today is flexibility. So having an idea of what the goal is, how much you want to save, and then where's the best place to put it. And it might be a combination. So maybe you use some Roth IRA for college funding. Maybe you also use 529, also maybe an UTMA account. So there's a lot of different possibilities. You want to make sure that you're diversifying your college savings goal from not just an asset standpoint, a tax diversification, but also the actual strategies that you're using. So you have flexibility once you're funding that goal. And again, that can also be used the same strategy with retirement and other short-term, long-term goals. Next slide, please. So as advisors, and I've been doing this 24 years, so it's been very exciting to work with clients, helping them reach their goals. And we love celebrating all those milestones with you. But it's important that we also think about all the what ifs and preparing for that unexpected. So many of you that have joined us today are still working. So if you're working, your biggest asset is you. It's your ability to earn an income. That income is used to pay for your rent, your mortgage, your expenses, all of your savings. Without that ability to earn income, how would you fund those goals? How would you fund those expenses? So it's important to look at what type of disability income protection do you have through your employer. So you might have short-term, long-term disability. You want to make sure that you have everything that you can through your employer. Now, even if you've done that, the maximum you might have is 60, maybe 70% of your base salary. So that doesn't include bonuses, doesn't include commissions, and that's pre-tax. So if you have 60% of your base salary and now you take taxes out, you might only have 40%. Is that enough to fund your lifestyle? Probably not. So it's important to look at, do I have all the coverage in place through my employer? And should I consider having a supplemental policy outside of work to cover the gap as much as possible? And along with insurance, we think about life insurance, right? And life insurance, I think many times people think, well, life insurance is only for people that have a significant other, who have young children, dependents, right? Or we have mortgages, liabilities, that's why we need life insurance. And that's true. You do need it for all of those scenarios. But life insurance is really a strategy that you can use throughout your life. You might use your cash value life insurance to fund a portion of college completely tax-free. Or later in life, as you're looking at your retirement and where's the best place to pull out money for retirement, you might use your cash value life insurance completely tax-free. And then even later as life, as you're starting to think about your legacy plan and you want to look at leaving money to your children to help offset taxes from the IRAs and 401ks they're going to inherit, or maybe you're very passionate about an organization that you want to leave money to and leave your mark on this earth, life insurance is a great strategy for that. And with life insurance, just like the college planning and retirement, there's several solutions. There's different types of insurance. So it's really important to meet with somebody to look at your specific needs of how much do I need and what are the right solution based on my cash flow. I think it's a good time too, as you're reviewing your protection needs, to make sure all of your assets are protected from probate. So reviewing your estate plan, or if you don't have an estate plan, to consider doing one. Having beneficiaries, you want to have beneficiaries on every single account that you own. So it's a good time to review beneficiaries and estate planning while you're doing this protection needs. Last, certainly not least, long-term care. So we're all living longer, which is great. And as we're living longer, there's also a risk. So there's a risk that we as women, as we're living longer, that we could use some sort of care, whether that be in our homes, whether that be in a nursing home. So we need to make sure that we're planning for that. I personally have clients who are paying anywhere from $12,000 to $16,000 per month for care. So you either need to have a lot of assets that you have available to fund that, or transfer the risk to a long-term care policy. And again, just like life insurance, there are several options. There's standalone long-term care. There are annuities and life insurance that also have long-term care riders. So again, many solutions, and you might use a combination. So as you see with our busy lives, right, there's a lot of areas to focus on with our goals, tax diversification, protection. So it's important to have a plan in place. So take time, focus on yourselves, focus on your goals. And I have my contact information here. If there's any questions you have specifically for us, ask us in the queue or reach out to us personally. And with that, I'm going to turn it back to Amrita.
Thank you very much, Claudia. Appreciate all the useful information about midlife financial planning. We will move on now to Allie Branca, who will talk about late career planning for retirement. Allie is a financial advisor at Raymond James in Rockford, Illinois. She has 11 years of experience helping individuals and families create a plan for meeting their financial goals and guiding their progress along the way. She is a certified financial planner and has experience in trust administration. Allie, it's all yours.
Hello. All right. Thank you. So there's going to be a little bit of repeat, but I think some of this is worth repeating because it's very valuable information. So when someone wants to talk about retirement, when it's seeming more imminent, I get kind of three basic questions. And one is, how do I know I have enough money to retire? Will I run out? Two, when should I file and claim my Social Security benefit? And the last one, how will the healthcare costs impact my retirement? So to try to answer these questions and make people feel a little less uncertain, there are some things you can do to prepare. So you can go to the next slide. Yeah. First thing, get a great team. Financial planner is probably your first stop because they can help consolidate all of this information, all of your financial information. But an accountant for specific tax questions, attorney to help draft any estate documents or update them if you haven't looked at them in a while. Your benefits administrator will help you know your distribution options from your retirement plan. And also if you're retiring before Medicare, if you have a continuation of health insurance coverage, or if you're not retiring at Medicare age, if your healthcare is creditable for Medicare Part D. I also recommend talking to friends who've been through it because they will help you avoid the pitfalls that they had to face. And sometimes they have really great referrals of a team that can help you. Next is to educate yourself on Medicare and Social Security. And we know there are lots of really good resources out there, SSA.gov, Medicare.gov. But your financial planner should be pretty educated in these areas, or at least have a referral to somebody that is. And then lastly, I would recommend that usually in the years leading up to retirement, you are in your highest earning years. Many people are. And so if you are, consider maxing out your 401k, your 403b, your retirement plan to the best of your abilities, including your health savings account if you have that available to you. I love health savings accounts because the money goes in tax-free. You can invest it and it can grow tax-free. And as long as you use it for medical expenses, it's tax-free. It doesn't expire. You don't have to use it by a certain amount of time. And you can use it for Medicare. And so I highly recommend maxing out your HSA if possible. All right, next slide. So when you go visit a financial planner, what will it be like? You'll bring in all of these statements with you from all your employer plans, any investments you have outside, bank accounts, all that stuff, and your debts. And then you will also need to look at what are your basic living expenses, food, mortgage, all of that stuff. And then also spend some time thinking about your dream retirement. So I would like to know, and when I do planning for people, I want to go big at first and see if that's possible, and then scale it back if it's not. So I would say, like, yes, I want to travel and I want to move to a warmer climate or whatever. Let's put that all in its software that we use and then see if it will work out. So we have a discussion, we put in all this raw data, and then you can go to the next slide. And what you get from it is software will predict the likelihood of success, likelihood of not running out of money with the assets and money that you have and the expenses that you plan to spend. It'll also run multiple market investment scenarios. So you can see in a bad market, in a good market, how might you do? And then if it doesn't turn out the way you planned, if it's a little too low, you could say something like, well, what if I work one more year? And we can immediately adjust it and show you, oh, look, it improves your plan. Or what if I get to retire a little bit earlier because I have such a great likelihood of success. So it's a living document, a living plan that you can see what ifs. And as you retire and things become not what ifs anymore, they are realities. We put those in, and then your plan just becomes more and more accurate. All right. So then next one, one of the most common sources of income in retirement is Social Security. So we're going to do just a high level discussion about this. SSA.gov for your benefits estimate will have lots of calculators. And I do recommend going on there and seeing how your benefit would change if you were to claim early or late and all of those things. Sometimes I use the word draw Social Security, but what I mean is file and claim when I say that. So your full retirement age is, or full retirement age benefit is the amount you're entitled to based on your age and work history. And it's between the ages of 65 and 67, depending on when you were born. So if you're born in 1960 or later, your full retirement age is 67. But you can draw early. You can start filing and claiming as early as 62, but then you are locked into a reduced benefit by as much as 30% and locked in for the rest of the time that you claim. You'll get cost of living adjustments, but you'll be starting from a lower number. And you can wait as late as age 70 to file and claim as well, and you'll get an increased benefit of up to 124% of your full retirement age benefit. And there's no benefit to waiting past age 70. They stop increasing it at 70. And just so you know, for reference, the maximum Social Security full retirement age benefit in 2024 is $3,822, which is about $46,000 per year. So many of us, even if we had the maximum, we'd still need to supplement our income elsewhere. But the average monthly benefit for retired workers in January of 24 was $1,909. So that's significantly less. And most of us will fall someplace between those two. All right, next slide. Concerns for women. Mary already discussed these. I'll briefly talk about them, but women do tend to have less retirement savings and Social Security benefits due to lower wages and gaps in our work history from caretaking. One thing too to note is if you're single from being divorced and you were married for 10 years, make sure you check your Social Security benefit for your ex-spouse, because you are entitled to that if it is higher, or half of theirs if it's higher than all of yours. So just don't leave anything on the table. But yes, combine that with the fact that we do live longer than men, and we are more likely to need paid long-term care, elder care, because 42% of women over the age of 75 are living alone, meaning without a spouse, as opposed to only 23% of men. So if you're the last survivor of, or the second to survive, then you might need paid care. So discussing long-term care, the longer you live, we know the more likely you will need care. Over 25% of people in their 80s will need help with at least 2 activities of daily living or have severe cognitive impairment. And those activities of daily living are a criteria like eating and bathing and that kind of thing. By the age of 90, that number goes up to nearly 50%. And we know that the average cost of lifetime paid care is around $280,000 for women and $200,000 for men. And as Claudia mentioned, in her area, it's even much higher than that. So how would you pay if you or your spouse needed care? Of course, it doesn't mean in a nursing home. It could be a nursing home, but it could be in your home, someone coming in. First, people start with family. So that's unpaid care. And when that becomes not manageable or not possible, they go to their savings or their insurance. And if those are no longer available or weren't available, then you would be dependent on Medicaid for long-term care. All right. And as we age, it's more and more important that our estate documents are up to date. I'm not going to go over all of these, but a durable power of attorney for finances is very helpful to get in place before you start experiencing any cognitive decline, because the durable power of attorney for finances does stay in effect if you were to become mentally incompetent. And it is very difficult to get that in place after you've already become incompetent. Then you have to have a court step in. I think everybody needs a will, even if you don't have a lot of property or assets, and that's because you want to make sure you can distribute your property the way you want it to happen. And if you have minor children, to name a guardian. There's some cases where people may want to trust, an attorney can help you determine that. And just another plug for beneficiaries, because 401ks, IRAs, life insurance, all of that stuff passes outside of the will, passes outside of probate. So just make sure your beneficiaries are up to date, who you want. Otherwise, you're going to be based on a court having to decide where those assets go. And as we age, we start to think about our legacy. So I really recommend having a verbal conversation with your heirs and beneficiaries, but also writing a letter to go over it even more, because one, it's hard to remember what someone might have said, and two, you can get your whole thoughts out. Securely store your important documents. We all know to do that. But one thing to remember is also include your online accounts, what ones you have and use, and the logins and passwords. And I know traditionally they say don't write down your passwords, but in this case, as you're aging, it might be important to write them down and store them safely. There are online services that will store all of your important documents and give delegate access to your heirs. If you would like to go that route for keeping these documents and keeping this information, they are paid services. Sometimes your bank or your financial advisor will have online storage for you available, or just use a physical lockbox. And just make sure your heirs know where to get the stuff, and also introduce them to your team, to your attorney, and to your financial planner. That'll be a great comfort to them when they need to start making these decisions after you're gone. So I just want to reiterate that no plan is still a plan. If you do not have long-term care insurance or savings, then your plan is to just rely on your family and friends and Medicaid. And if you do not have a will or estate documents, your plan is to follow the decision of your state's probate court. So that might not be what is in your best interest or what you would like. So that is all I have, and I'll send it on back to Amrita.
All right. Thank you very much, Allie, for your helpful information about late career or retirement planning. So, and I want to thank all of the panelists for very quickly addressing the questions that have been popping up in the Q&A session. And I know that a couple of you are still doing that as I speak. So what I want to do is actually bring up a couple of questions that we received through emails while people were still signing up for the webinars. And I'll also keep an eye on the Q&A session, since questions will keep popping up. I'm sure we do have a little bit of time. I think the first one I will do, actually, since Allie, you were just talking about retirement planning.
Mm-hmm.
I'll bring up a couple of questions that came up in emails that were sent to us, or during the registration process, I should say. There are two questions. One, actually, there were multiple questions about should we be looking at annuities for retirement, and what kind of annuities, and where should we begin? I know that's a big question, but that's why I wanted to start with that and with you. And of course, the other panelists can hop in as well after you've responded, Allie. Go ahead.
Yeah, so I would welcome the other advisors on this topic as well to chime in. I think annuities are useful, but definitely not for everyone, and definitely only a portion of your retirement assets, because they are inflexible. So I would just say the safest with the most payout is an immediate fixed annuity, but if then you have market risk. So there's just so many things to consider with an annuity. It's something you really, really need to understand and ask a million questions to your financial advisor when considering an annuity. But yes, I don't think it's for everyone, but I do think it could be very helpful for some. What do you guys think?
Yeah, I agree. I think it's a solution that we certainly use with clients in certain situations, and there's so many different strategies, like with any goal that you're funding. So to your point, working with your advisor to see if that's the right solution. Is it for death benefit protection, or is it for creating income? What are the, returns projected, or what are the caps? If it's an indexed annuity, what are the fees? You just want to understand what you're getting into. And that's really with any solution that you're doing. You want to fully understand what you're doing and why, and might be a right fit for you.
Okay, I will move on to a more general question. Again, that was asked during the registration process, which is, should someone who is married maintain a non-joint just in case fund, and how to do this without appearing like you're anticipating a breakup? I know this is not really a finance specific question, but yet it's something that I'm sure many women are thinking about as well in terms of their security going forward. So do anyone of you want to speak to that?
I'll start on that, but I know Mary has some stuff on that too. But just that I don't think it's necessary for everyone, because if you're talking about a divorce situation and you didn't own the account pre-marriage, it's not going to be your money necessarily, if just because it's in your name. Things that are opened and funded during marriage will be marital assets on the table, but also unless it was a gift or inheritance, that in that case, then it could be just yours. But Mary, you can talk about the need for like independence and that kind of type.
I generally think that it's a great idea to have your own account. And the arrangement for this varies really dramatically. Like when I got married, my husband and I both had joint accounts, and then we opened a separate, or we had our separate accounts. We opened a joint one and put all of our like wedding money in it. And then we kind of never touched it again because we still had our paychecks coming into our original accounts. And then when I stopped working, I didn't have an income. So I started using the joint account more, and like, our use of the financial, landscape changed over time. And I think that's totally fine, but you want to have a little bit of personal autonomy. And I think that if you're with a person who is uncomfortable with you having that, that's a red flag to me. Like if your partner, you can use a joint account for most of your spending, but if your partner is like really against you having an account, you need to ask why. Like what's the problem with me being an independent person as well as a part of this union,
That's
I just
great.
wanted to say too, I think just real quick to that is it is important, men and women, to both be part of the financial planning. I think as advisors, right, we want the husband, wife, whoever, everybody that's in the financial picture needs to be involved. By having just one person saying, oh, I make all the financial decisions, not a good idea. You really want everyone to be part of that picture of the family, right? So if you've got two spouses you're working with, it's important they both understand what they're doing and why. And I agree, having the separate accounts. And we could have a whole conversation on prenuptial agreements. I agree. I think those are very good documents to have in place. Doesn't mean you're setting yourself up for divorce. You're just a planner. You're just protecting yourself and your family.
I would just say one more thing to tie it back to the credit slide that we didn't talk about. Once you enter into a marriage, you might end up using joint credit cards, which is totally fine, but I would recommend that you not cancel your individual credit card because it'll help protect your credit score. If you're going to be getting a mortgage together anyways, you both need your credit scores will both count. So to protect yours, you want a long credit history. And if you close your previous account and only have like a short history since you were married, that's going to hurt your score.
Great. So thank you very much for those answers. I thought I'll throw this one out, and I'm sure all three of you will have something to say on this. I think it's an important question that that was thrown in the Q&A session. What are the most important things to consider when choosing a financial advisor for the first time? How do you even find one?
Mm-hmm. Yeah, I mean, I think if I can chime in, I think for us, most of our clients come from referrals. And I think when we look at who we're working with, you want to choose somebody who, most importantly, like Do you get along with them? Do you have similar personality types? Is that the person that you see yourself working with long-term, right? That's, I think, one important element. But number two is, of course, education, experience, and are they someone who works with clients like you, who understands your situation and has worked with those scenarios many times over and can come up with the right solutions? So I think it's a mix of a few things. It's, of course, the education, the background, having a fiduciary, someone who's acting in your best interest, and then someone that you see yourself working with long-term, because that is somebody you want to have for a long-term through all of your financial goals.
And I would also just, our industry is highly regulated, so you might not be able to do the typical thing where you just Google and read a ton of reviews, because sometimes they're regulated and they don't even allow reviews to be posted for people. So it might help to ask your network who they work with and who they like.
Yeah, I think that's a good idea. And I would also just advocate for like maybe talk to a couple of different advisors, just like an introductory meeting to get a sense of whether you like, can you work with this person? Do you trust them? Are they talking over you? Are they listening? Do they seem to be concerned about the same things that you're concerned about? That's going to help you get a sense of whether, you know, you're going to feel in safe hands, because the number one thing about your financial advisor is you have to trust them.
Right. Now, we had a question about will preparation. So I know that when I wanted to put a will together, I just Googled local lawyers and looked at reviews and went and saw someone got the will done. But the question we got is, are there reputable online will preparation websites? Have you experienced that, doing wills online? And if those are likely to be reliable, because you really want wills to be soundly written and legally watertight. So would you recommend going the online route or just walk into a lawyer's office and get it done there?
I would recommend seeing an attorney. Most can do it pretty inexpensively, not as cheap as probably an online. And online is probably okay, but sometimes it's helpful for your particular state to talk to somebody who is an attorney in your state, and also just who has experience and can help guide you. You might have a lot of questions.
Right. And I think with an attorney, it's like your financial advisor. You want to work with somebody that you hope you'll have a long-term relationship, because your life will change. Where you are today will change where you're at in 5-10 years. So your estate plan will also need to be amended. And so having that person that knows you and is knowledgeable that can make those amendments, it's a good resource to have.
I think maybe it could work for a real young person who doesn't have a lot of assets or life complexity yet. And you know, once you have money to worry about, or, you know, beneficiaries to worry about, then you want to be really serious.
So Mary, I want to throw a question at you specifically. There are a couple of questions I got, which I think would be relevant for the early career stuff that you talked about, although I think any one of the panelists can speak to it. And I'll kind of bring them up both together, and you can pick and choose which bits you feel you can comment on. And again, these are not specific, tell me what to invest in, but more generally about if someone's already paid off all of their debts, like student debts and mortgage, and they've got their 6-month emergency fund established, what general thoughts would you have about where to invest the money? And also thoughts, especially for young people, and where to find extra money. I know this is very general, but whatever advice you can get, that would be helpful.
No, it's good. So once you have like the easy stuff taken care of and you start to put away a little bit more, like if you feel comfortable for it, you could manage it on your own. You could open an account at an online brokerage. And especially when you're young, as long as you go with a low fee ETF focused on the broader market, like you do a little bit of reading, but you shouldn't be afraid to get invested right away because you don't have enough assets to really engage a financial advisor. A lot of times,
something simple like Vanguard or Fidelity account online, just like that.
You can start an account like that with your you know, extra savings. And that allows you to have the flexibility that you can save that money for a while. And then if you need it for another purpose, you can always reallocate it for your, child's education or whatever. You're not like stuck in. If you open a Roth IRA, you might just really want to use that money for something else, but you can't. But I think if you start to accumulate a lot of money, like $100,000, you want to start sanity checking your broader financial plan. When you have not that many assets, you don't have a complex situation. I think maybe working with somebody on an hourly basis to sort of get a plan in place is a good idea. But hiring somebody for like a fee of assets under management at that stage of your life might be, one, it might be hard to do because a lot of advisors have minimums, and two, it's expensive for you because you're paying somebody and you really just want to be earning that return. I think once you have a more complex life situation, the value that a financial advisor can bring to your situation is a lot higher, and it becomes more worth paying for that.
Sounds good. We're getting questions about whether any of you work with clients remotely.
I do. I'm all remote.
I was going to say, I have an office, it's in a suburb of Chicago, but we have clients in 26 states across the country. So yes, luckily for technology, right? We can all work with anyone, anywhere in the country.
And what kind of professionals would help, again, looking at questions that are coming in the Q&A session, would help people figure out student loan repayments and managing debt and strategies like that? Would those be regular financial planners like you, or would they be more specialists? Good question.
I think when we're working with clients, if they have student loans or credit card liabilities, we will first look at, of course, their short-term and long-term goals, and then prioritize the liabilities based on the interest rates, right? If the one's at 10%, one's at 0%, looking at payment structures. So we'll work with that specific goal for the client. We don't outsource. I know there are companies where you can consolidate debt, but we really try to focus on how can we just have a plan in place to pay off the debt in the most efficient way.
Okay. And I think we might have time for just one more question before Barb starts showing us the time that's running out. So I'll pick one more from the Q&A session, which may be a little bit too specific for the webinar today, but I'll throw it out anyway. And it's a question about, does it make sense to give your home to your child 10 years before you intend to retire so that a retirement home doesn't seize your home to cover costs, or do you think that's not a good idea?
I was waving my head no, because I think a lot of people start thinking that they should change all of their assets to their children's names, but there's a 5-year look back period. That's one issue. And number two is when you give away an asset, consider it gone, even if it's your children, your friends, your family, it's gone, right? It's not yours, not for yours to control. So that's not the planning I would recommend. Certainly you want to look at protecting your assets with long-term care insurance, life insurance, and an estate plan. But that's not something I would recommend, is changing and of course, tax implications. We haven't talked about that, but there's tax implications when you're making those types of changes too.
Okay, so don't give away your assets. And Barb is here. So I will thank the 3 panelists. Thank you for all the useful information you shared today. I certainly learned a lot. And to the audience, we will definitely share the slides with you after this webinar is over. And with that, I will hand it back to Barb.
Well, thank you, Amrita, and thanks to our panelists. What a great load of information. And I'm really impressed with our panelists because they have been busy in there answering some of your questions in the Q&A. So kudos to them. Now, if you'd like to dive into any of these subjects further, I do want to reiterate, and thanks to Mary for giving it a plug, but the Life Lessons webinar series is available on our website. So you simply have to go to tippie.uiowa.edu. If you click on the word alumni at the very top, you can see our alumni resources. And there you can see all of our webinars on all different topics, but specifically the Life Lessons webinars. They live on our website, but they also live on our YouTube channel, just like the recording for this webinar will as well. In addition, we'll send an email out to everyone who registered with a link to the video and a link to the PowerPoint slides as well. Our webinar has been recorded. You will see a survey when we're done. It'll pop up onto your browser. Please take a few minutes. Let us know what you thought. And also share ideas for future webinars. We always appreciate getting those ideas so that we can make sure that our programming fits what you need in your life. So on behalf of the Tippie College, I want to again thank all of our speakers today. And I want to thank you for joining us today. Happy spring. It is, I believe, the first day of spring. And as always, go Hawks.
Go Hawks.
Go Hawks.